This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from three Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers, and Mark McGrath, associate portfolio manager at PWL Capital.
Nice touch on the intro, a little modification. Very well done. First take.
Cleaned it up.
What was different? What'd you drop?
I took out one of the PWL Capitals. Instead of saying Ben and Cameron, portfolio managers at PWL Capital, and Mark, associate portfolio manager, I said the portfolio manager piece is first and then the PWL piece second. I thought we could get a little bit more efficient, although we've now lost that efficiency by discussing the change.
Yeah. This is the kind of stuff that you work on in your spare time, hey Ben.
This is Ben's deep thinking. Anyways, welcome to episode 307. And this week is a little bit different prep on our side. Mark, you came up with a couple of topics, so maybe you want to kind of cue them up. Sure.
Yeah. So recently I was thinking about life insurance, as one does, of course, and it kind of occurred to me that I very frequently see clients who have, in my opinion, the wrong amount of insurance. And they'll have some term insurance in place, but how they derived the number for the size of the policy they bought seemed kind of like stick your thumb in the air, or an agent kind of picked the number for them. And when I do insurance needs analysis for clients, I usually find the number to be inadequate. And so I thought it might be helpful to write a piece on how to calculate your life insurance needs, like yourself, just using a couple online calculators and some tools.
Cool.
So I wrote this piece and I thought it'd be a good topic for today's conversation. And then the second topic, same kind of thing. I wrote a piece about this, but I had sold my rentals last year. And we've talked about that, I think, on the podcast here.
Yeah.
And so when it came time to do my taxes this year, I was prepared for a big tax bill for the capital gains. And then when I started crunching the numbers on it, I was like, I think I can eliminate a lot of this tax bill using the principal residence exemption, because I lived in one of the rentals for a period of time, not the full time that I owned it, obviously. And when I got to it, I eliminated 60% of the capital gain on the property, and then combined with RSP contributions and income splitting with my spouse, who was a co-owner who's not working, I actually ended up getting a tax refund, which was really interesting. So I thought I'd just kind of walk through how that principal residence exemption works and how it affected me personally with respect to that rental.
And then after that, we're going to try a new segment that Ben came up with. Ben, you want to tee that up?
Yeah, we're going to play Would You Rather, which is a game that lots of people will be familiar with. There's many different iterations of it. We're going to play it with financial decisions. So we're going to queue up a question of would you rather do this thing or that thing as the game goes. But it'll be, I don't even know what we're going to do yet today. Cameron mentioned that the prep has been a little bit different today. What he meant by that is we've done very little prep. Cameron and I, Mark did more for this week. But this is by far the least prepared that I personally have ever been for a Rational Reminder episode in my entire Rational Reminder career. So hopefully it goes well. I'm sure it will.
It's going to be great.
I think you'll be okay, Ben. This doesn't require 62 academic papers being read the week before, right? It's just a couple threads that I wrote on Twitter. I think you'll be okay. Yeah,
it'll be good. It'll be good content. And the second one is, I've said this before many times when we've covered Canadian topics. The second topic on the principal residence exemption is Canadian specific, but it's also a super interesting optimization problem that I think, and I've heard this from many listeners, that even if it's not exactly the same in their country, there's some similar analog where the decision-making framework is still useful. So I think we'll definitely get some of that.
Cool.
Yeah, well, the U.S. is quite different, right? I mean, they don't have, I think they have a principal residence exemption on gains up to, I want to say $250,000 per spouse. But so it might not apply there. But to your point, maybe the decision-making framework will be interesting.
Yep.
All right. And after that, we go to the Aftershow and see how it goes from there.
Cool.
All right, let's get going.
So my wife and I have $2 million of term life insurance each. And we arrived at that somewhat strategically. We worked with an insurance agent to implement the policies, but I wanted to discuss how we came up with $2 million.
Are they policies or one policy?
Good question. So we have a joint first to die policy. And so the first of us to go, the survivor will get $2 million. And we bought a term 20 policy, and this was back in, actually I should clarify, we bought two $1 million policies. one for 10 years and then one for 20. The idea being after 10 years, the $1 million of coverage will drop off. Ideally, we've converted our human capital into financial capital and our need for insurance is lower now. So we can let the one policy just expire. And then we'll have 10 years left on the 20-year term for $1 million. But they're both joint first to die. So whoever goes first, the survivor gets it.
Sensible. Gotcha.
I believe so. And the way we thought about this was we wanted the survivor to be fully covered for life, right? Like when we think about insurance, it really is a spectrum. Like you're transferring risk to an insurance company. And I think the question is, how much risk do you want to transfer? And so for some people, they're okay just covering things like debts. They just want to make sure the survivor is able to pay off the mortgage or something like that. And they might expect the survivor to go back to work or to remarry or something like that and worry about their own financial independence afterwards, just cover the debts. We went the full other direction and said, like, look, if one of us goes, we want the survivor to be able to raise our kids, fund retirement, never have to worry about going back to work, never have to worry about, remarrying or finding somebody with money. So one of us dies, the other's set for life if they choose to be, right? And that's, I think, the extreme end. Like when I wrote this thread, a lot of people were like, you're overinsured. And I was like, well, no, that's our goal. Like we had conversations about what we wanted for the survivor, and that's what we determined for ourselves. Not everybody's going to go to that length, but we were comfortable with that.
How much of that decision was predicated on knowing that term insurance isn't that expensive?
A big chunk of it, right? Like our policies, I should say, we pay about $2,000 a year, and we got them when we were in our mid 30s, I would say. And like kind of standard health ratings, like no concerns there. And I think it's about $1,800 annually for the whole kit. So it's very cost effective. So yeah, the amount you need is going to depend on the goals that you have for your family and for the survivor. And if you've got kids, you may want to fund things like education plans for the kids or homes for them, like whatever it is that your goals are. But I'd say at the very, very minimum, the first thing you should consider is your debts, right? And so that's pretty simple. You look at your balance sheet, you tabulate the total amount of all your debts, consumer debts, credit card debts, mortgages, loans, lines of credit, student debts. Just tally those up first. That's your starting point, and I would say that's the absolute bare minimum that you want to consider if you're looking for life insurance. Now, I should specify that I guess there are probably situations where you don't need to cover even your debts, right? Like there's no blanket approach here, but as a minimum, I'd say look at your debts. The second and generally much smaller amount that I added to that was funding things like an emergency account, final expenses like funeral costs. I want my wife to throw a massive party if I go, like 6 figures, like higher bands, like open bar, the whole nine. Assuming I have friends at that point that will actually show up to it, but I wanted to be able to fund like a party, right? Not
you
a
really
somber
thought this through.
funeral. I think so. Yeah, we'll see if it all works out in the end, I guess. But this is based on conversations from say 5 years ago, and life changes, and that's something that I think is important, and we'll discuss is that you should review this pretty frequently because life changes pretty fast, right? So emergency funds, final expenses, and also any short-term expenses. Like I'm going through a landscaping project right now. If you had that planned already and you knew that was going to cost $150,000 and that was still important for the survivor to go through with that expense, you might want to add any short-term goals that have been planned for but not yet completed or implemented. So that's kind of the second part. And then by far the most complex and potentially important part in our case was income replacement. So the biggest asset for most people is their human capital, their ability to convert their income into financial capital over time. And calculating how much you need for that income replacement can get a little bit tricky. And it depends on the depth that you want to go to. So we don't know how much income we're going to earn over our lifetimes, right? We just don't know. But I think your current, depending on your stage of life, like your current salary maybe, or your current income adjusted for inflation is a reasonable starting point. Of course, if you're fresh out of university with a starting position, you might want to start with a higher salary number, accounting for the fact that you expect your income to grow maybe more rapidly than inflation over the first 5 or 10 years. But the idea is to get an idea of what you think your lifetime income is going to be between, today and your expected retirement date. And that's the amount that you want to cover with insurance. But there's 2 big things that affect the amount that you want to buy, like the amount of insurance you want to buy. And the 2 big things are inflation and the expected return on the portfolio that the survivor would implement, right? So if I go and my wife gets say $1 million or $2 million, what's the expected return that she's going to get when she invests that money, right? And so if she was really, really conservative, a very conservative investor, I would use a lower expected return for her. Whereas I'm a very aggressive investor, I'm effectively 100% global equities. My expected return is higher, right? So if she were to go, sorry, go ahead.
Why did you go at it from the income side as opposed to the expense side? Can you talk through that?
Yeah, that's a good question. I think that's probably a more. I think it kind of depends, right? Like at higher income levels, you probably want to use expenses. Like if you're a physician earning $500,000 a year and you're only spending $100,000, it's really the expenses that you want to consider.
But expenses and future saving. Like if someone's earning $500,000 a year, right, then they want to be able to replace whatever they were spending. But if someone's super frugal, that doesn't mean they need less life insurance.
True. And so I broke this down into two parts. Like one is just covering the lifestyle expenses, but the other component to this, which you can combine, is calculating the need for retirement income. So replacing the savings that you would have, right? So at the time that we calculated this,
it's not a net
we
present
used
value
income.
of lifetime spending is what you're saying. You're doing like saving, your spending needs up to say age 65 or whatever retirement age, and then the ability to save in that to fund your own retirement.
Yeah, and you can combine those two into one calculation, but the way I broke it down, just in the way that I wrote it so that people understood the two components separately, I did like basically income up to age 65 and then desired retirement income from 65 to say 95. Gotcha. We usually go out to 95 for projections, right? But you could combine that. Like if you're 30 when you're buying insurance and you want income replacement all the way out to 95, you can essentially combine this into two calculations, right?
Right.
Does that make sense?
Yep.
Okay. So the example that I wrote out was for a 30-year-old making about $100,000 a year and expecting a 6% annual return on the portfolio for the survivor, as well as 2.5% inflation throughout the life of the plan. Now, obviously, varying either of those is going to drastically impact the amount of insurance that you should buy for yourself. And there's no perfect way to know exactly how much insurance you should have. So I would say you might want to do this calculation with maybe higher or lower inflation and higher expected returns and maybe take an average. But just this will give you a good idea, at least of a starting point. So with a 6% annual return and 2.5% inflation, you're looking at a 3.5% real return for the survivor. And what I did is I just used a present value of an annuity calculation to figure out how much over 35 years, this person's 30, we're taking them to retirement at age 65, over 35 years to replace $100,000 of income adjusted for inflation at 2.5%, what's that lump sum that they need today, right? And using a present value of an annuity calculator, which just calculates if you were to buy an annuity for a set amount of income, what is the lump sum value that you would need today to purchase that annuity from an insurance company? And there's many good calculators online to figure that out. But in this case, the math works out to around $2 million. So $2 million of cash today at a 3.5% real return after inflation would be enough for $100,000 of income for the next 35 years for the survivor.
Can you clarify how are the present value of the annuity and the expected return being used differently?
Well, I use 3.5% for the annuity.
Oh,
right. So I use the real return for the annuity calculation. So if you go to like a present value of an annuity calculator online, the inputs they're going to ask you for are what is the income you desire, what is the interest rate or basically the return, and then what is the number of years over which you need that annuity to pay. And so I use the real return of 3.5% here to account for inflation.
So it's just a present value calculation, not like an annuity pricing calculation.
Because
if you did like an actual annuity, I thought you were talking about annuity pricing. Like if you priced out an annuity for the same thing, you'd need way more, presumably, than if you were investing an asset at 3.5% real.
Right. Well, an annuity, I guess, at age 30, you would need way more because that would be into perpetuity, right?
Yeah, you couldn't even buy it in the first place.
Yeah. In this case, I specified the number of years that I needed the annuity to pay out for.
Got it.
Does that make sense?
Yep.
Okay. So in that case, you need about $2 million, right? So far we've got debts, we've got short-term cash needs, and we've got $2 million for income replacement all the way out to age 65.
Can I make a couple comments?
No, Ben, absolutely not. You haven't prepared.
So I know what I'm going to say.
I know.
I prepared in my head while you were talking.
Yeah.
One is that when we do this for clients, we use financial planning software and we just like model how much they would need to make their plan sustainable with an early death. I think the way you're describing it is something that anybody could do, but just to be clear, that's not how we do it. We use financial planning software that does Monte Carlo simulation, figures out how much insurance you'd actually need.
Yep.
Personally, I did not do that. I didn't do our financial planning approach. I just used a 2% withdrawal rate and figured out how much, like same type of thinking that you did in terms of how much would my wife and kids need to fund their ongoing lifestyle. And I just used a 2% withdrawal rate, which is super rough and probably overly conservative, but pretty simple too. So, and just pointing out that the way that you've described how to do this makes sense. There are simpler ways to do it that are probably okay, and there are also more complicated ways to do it that are probably better, but maybe marginally.
But no, you're right. My original question around costs, like over the years when I bought insurance, I always just aimed high because it was such a nominal amount of money to get way more coverage. Like, yeah, the math might say X, but I can get 50% more than X for in the hundreds of dollars more per year. So over the years, we always just aimed higher.
Yeah, I have way more life insurance than you do, Mark. I don't know.
Yeah.
I don't know the intricate details of your financial situation, but I have a nice one-page insurance document that I wrote for myself. I'm looking at it right now. I have $4.7 million of coverage on myself, and my wife has $1 million.
Yep.
She does not earn an income. So yeah, it would be a bigger deal financially for our household if I died. But yeah, very different from your numbers.
So a few things. One, we use fairly advanced financial planning software to calculate this, right? Like my goal for writing this was more towards like if you're getting sold insurance by somebody and they're just kind of sticking their thumb in the air and picking out a number, if you want to go and like kind of get into the weeds a little bit about how to think about calculating the amount of life insurance you need, that's why I wrote this thread. The way you've done it, just basically like dividing by the safe withdrawal rate that you're comfortable with is going to get you relatively close as well. Yep. And like I said, like there's no way to know actually how much insurance you need to perfectly line everything up. And so in our case, at the time that we bought the insurance, my wife was actually earning more than I was. And so it made sense for both of us to have the same amount. And since then, we've had 2 kids and she's stayed at home for the past 5 years. She will go back to work eventually. But now my income is basically the income for the family, right? And so things do change.
Since you updated your life insurance, Mark, that is like the time to update your life insurance is after having a child.
So we actually bought it while my wife was pregnant with our first, right? Nice, so it was anticipation of the first one. So we were aware of that. And then obviously the second one. But I've looked at it since. And as I mentioned before, we have saved a good amount of money since then, since that happened. And so we don't need more life insurance just because we've had a second child, but some people might, right?
Yeah. But go the other way. Think of the number of people that you've met over the years that say, I don't believe in life insurance, or my spouse will be fine. Like, you have to give this kind of math serious consideration. It's no joke, right? And you said it off the top. It's all about who do you want to assume the risk of something happening.
When I wrote the thread.
Go ahead, Mark.
Sorry, I was going to say, when I wrote the thread, somebody reached out to me and said, like, how do I get this concept through to my son? Because they have that exact viewpoint that insurance is a scam and they don't need insurance. And in this case, this individual was quite religious and said that their God would, show the survivor the way. So to your point, Cameron, how much risk do you want to transfer? In their case, they were, I guess, spiritually transferring their risk to the deity that they worship instead of to an insurance company, which is just a really fascinating way to think about it. But I wasn't able to really answer that question for that person that reached out. I was like, I don't know how to kind of pierce that veil, or if it's even a conversation that you want to be having with that person, right? But and maybe I think as some people get older and kind of mature and start to see, or if a life event happens that kind of spooks them, they go, okay, like they start to face their own mortality and think, yeah, this is the time to start thinking about insurance, because you never know when you're going to go, right?
Well, it's the other interesting thing, right? People always, when something happens near to you, family member or people around you, neighbors, where someone dies, all of a sudden the risk seems higher. But that doesn't change the basic statistics. Like for me, there's a 1.16% chance of me dying in the next 12 months, of a 58-year-old male dying in the next, as a population, not taking any specifics about my health or history.
Yep.
Just to your earlier point, Cameron, about the cost. So for my $4.7 million of life insurance coverage, I pay $248 a month, which is not, I mean, that's a lot of money. I don't want to minimize that, but it's also, I think, for what you get. And the difference is like, I've got a $2 million policy. The premium is $121 a month. And then 2 other policies that are each $65 a month on different term, like term 10 and 20, for the same reason that you described earlier, Mark.
Yeah. When did you get them? Like at what age?
You know what? I don't have that on my sheet. I have when they renew. I don't have when I bought them.
Because I'm just pointing out that the younger you are, the cheaper it is, right?
Yeah. Definitely.
And men are more expensive to insure than women because women tend to live longer, right? So it's just interesting though, because the younger you buy it, the cheaper it is. So like I'll see young, like late 20s, people getting $1 million, $2 million of term insurance for like $900 to $1,200 a year, right? Like you're talking $100 a month. And you mentioned the cost of, $248 a month being quote unquote expensive. And it's like, I like to say about disability insurance, like if you think the policy is expensive, imagine how expensive life's going to be if
Cameron
you get disabled well, that's just it, right? Like if you
what
can't
you
afford
do,
that cost, you can't afford to get disabled or die.
If you can't afford it, you cannot afford it. Like,
yeah, exactly.
That's it.
Yeah. No, that's very, very true, right?
Yeah.
Or the old, no matter what, I can drag myself in front of the computer. It's like, really? Over the years, we've seen some pretty horrible things happen to some pretty great people.
Yep.
That rendered them unable to work.
Yep.
Oh man, head injuries, brain injury type stuff. People can't even look at the computer anymore.
Yep.
I have a client exactly in that scenario. She got in a car accident and can no longer, she can't use her phone. So when we have to send documents back and forth, we have to mail them now because she can't use a phone or a computer. If she walks into like an office building, she has to wear sunglasses because in her case, it's the light that the computer and the phone gives off. But head injuries are
same as the one I'm thinking of.
Yep.
We've seen it happen.
Yep. So the second component that I calculated was just the retirement costs, right? So right now we've kind of calculated your working lifetime income. Now I'm calculating the post-work life income for the survivor for retirement. And it's a similar idea, but you just have to adjust for inflation between now and retirement, right? So basically, and I actually used the shortcut that you described, Ben, like a safe withdrawal rate shortcut. And you do get different numbers doing that, but they're relatively close. So for retirement, in this case, to keep it simple, I said, okay, they also need $100,000 of retirement income for the survivor. And at a 3.5% withdrawal rate, which I know is more aggressive than what you've used and even more aggressive than what you've shown in some of the work you've done. But for the sake of the example, I hate the 4% rule, so I just basically brought it down from 4%. You just need to figure out what's the inflation adjusted amount in retirement, I guess, that the 3.5% safe withdrawal rate would allow you, or you would need to basically be able to withdraw 3.5% into perpetuity at $100,000, and then you have to adjust that by inflation, right? So for this 30-year-old hypothetical scenario, at a 3.5% withdrawal rate for $100,000 a year of income, they would need $3 million in today's value, which works out to about $7 million in nominal value at retirement, right? These are big numbers. And then just work backwards. What's $7 million 35 years from now? What would you need today at your expected return of, say, 6% to get you to $7 million 35 years from now? In that case, it's about $1 million. So if you have $1 million today and you just park it at 6%, that will grow. This is obviously before tax, but that will grow to $7 million at age 65 or in 35 years from now. And that $7 million at a 3.5% withdrawal rate would allow them to have an income for life of $100,000 adjusted for inflation. So there's probably some shortcuts to this. Like I'm sure I just walked like the long way around, and I've probably done more math than I needed to. But in my head, sometimes I have to make things really, really simple and break them down into really simple steps for them to make sense to me. So that's how I thought about that. So what you get is $1 million for retirement coverage, and then we said $2 million for income coverage during their working career. So you're looking at $3 million now just for income replacement. But Ben, to your point, if you just assumed a 3.5% withdrawal rate on $100,000 starting today, if you divide $100,000 by 3.5%, you get 2.85 million, which is very close to the $3 million. Yep. So that's the shortcut, right? Mm-hmm. So we've got $3 million now for income coverage. If you add in the debts, if you add in, the cash needs, you could be in the $4 million range. And for a 30-year-old, that just seems like an astronomical amount of money in a lot of cases. Like telling a 30-year-old, yeah, you need about $4 million of insurance. It might, on the surface, it might seem like a lot, right? And so often what I've seen is insurance agents will say, yeah, but let's go with 2 million, right? Because 4 seems excessive. But if you do a proper needs analysis for a client, an insurance needs analysis, you're likely to come out with a pretty big number. Like I've seen some of my physician clients in their 30s, and we look at their insurance needs, and I'm like, yeah, you need $12 million. And they're like, what do you mean I need $12 million? It's like, well, you earn $500,000 and your spouse earns, $300,000, and you need a lot of insurance to cover off the total amount of income and expenses that you're going to face over your lifetime, right?
But again, how many people have you seen that have smaller policies, like a few $100,000? Oh, enough to cover off my mortgage or whatever. And they haven't thought through the income replacement, let alone the retirement replacement.
Yep. And like you said,
almost
it's cheap enough
feels
to go.
like it's just enough to get the sale closed by the agent. I know that's a pessimistic view.
Yep.
But in many cases, that's what it feels like.
I saw it yesterday with one of my newer clients, and we were looking at it, and he has, I think, $1.5 million of insurance. And I ran an analysis using the financial planning software that I use for him. And I'm like, you need about 5.85 million. Like that's the number that I'm coming up with. So you're underinsured by, 75%. Now, if we make these tweaks, like if you were to pass away and your spouse is willing to downsize the home, free up a ton of capital there, cut their expenses by 40%, cut their retirement expenses by 40%, then you're still short, but only $1 million short, right? So this goes back to that spectrum of risk and what sacrifices you're willing to make or not make when talking about your family's goals. We just went like the full meal deal, and Cameron, like you said, is cheap enough. Like, why not just get the coverage? Because you can always cancel this or amend it later. Like you can always get a new policy or just cancel it outright when you've built up the savings and your net worth is sufficient, right? Yep. There's some free online tools that are pretty good, I find, as well. So I've always used, it's a calculator called InsureRate by Manulife. It's just a free tool online that people can use. It's just a little bit more detailed, I find, than some of the other free ones. The nice thing is it will show you also disability insurance, and it will give you kind of a ballpark quote or estimate for what the insurance might cost, given what the inputs that you've used. So I find that's a handy way to do it. And if you're working with an insurance agent, like ask for a full, we call it an insurance needs analysis. So make sure you're getting an insurance needs analysis and not just, a back of the napkin type of calculation. And then, I think the last one is that, like I just mentioned, you can cancel your insurance when you don't need it anymore. And when I wrote this thread, there were a lot of people saying like, oh, you'll always need insurance. What about this? What about that? And like, I have no interest in a permanent insurance policy for my family. Like if I've gotten to the point where I can cancel my term life insurance, it's because that risk has been taken care of. There's no longer a financial risk to my death, and my spouse and kids will be fine, and there will likely be something left for them at the end anyway. So I just don't have a need for a permanent policy.
Yep. Same as me. I bought one once though, sold it to myself when I was an insurance agent.
A permanent policy?
Yep. I had to meet a weekly sales target or something.
Do you still
I don't have it anymore.
Oh, no, you don't? You dumped it?
Yeah.
I have a very tiny permanent policy I bought ages ago, like $100,000.
Yeah, I ran the calculation of, am I better off canceling it and taking the hit or continuing to pay? And yeah, I was way better off taking the hit.
Interesting. It's tricky because there's a sunk cost there, right? And I think a lot of people have difficulty just dealing with that sunk cost. Like I talk to people all the time, and it's like, well, I've lost $14,000 to 2 years of permanent premium, so I'm just going to keep it. But to your point, Ben, you need to calculate that cost and whether it's worth keeping.
There's the sunk cost, and there's the opportunity cost of future premiums going into the policy, and the opportunity cost of any cash value that may exist in the policy.
Yep.
So I got like some small amount of cash value because I'd had the policy for a bit. and then I had whatever, I don't remember what I was paying in premiums, but I can redirect that now to other stuff.
But it's interesting because the commission on that policy, you could have thought about it as a discount to the premiums, I guess, which would have changed the math, no?
Would have changed the initial math a bit. Yep.
Yeah. But there's some ongoing commissions with permanent insurance, like on the anniversary date as well, right?
Yeah, but for a policy that size, it would have been nothing. Like probably too small for the insurance company to even distribute.
Interesting.
Just love all these true confessions about life insurance. This is good.
I've never bought a permanent insurance policy. I actually just got a quote for a permanent insurance policy for my kids, though. I think that's actually a fascinating strategy. Once you've, I think, ticked all the other boxes, like if your RSPs, your TFSAs are maxed, education funds are maxed and funded, permanent insurance on a child's life as a parent actually becomes a really interesting topic, because when they become adults, you can transfer the policy to them on a tax-free basis. And I think there's a number of reasons why that's not a bad thing. So in general, I have a bit of a disdain for permanent insurance, but when it comes to these policies, I'm not yet convinced that they're bad.
Skeptical.
I know
you've said this to me before, and I've been skeptical, and I remain skeptical. Like you think that the policy growth, because the cash value of the policy is what you care about in that case. You think the cash value growth in the policy will exceed your after-tax rate of return at your tax rate?
Potentially. And I think the other interesting component there is just the insurability question. Like they at least will have some insurance in place. And so if there was something that happened to my kids from a health perspective, they would at least have some kind of form of insurance, and they could use it they can, borrow against it and that type of thing. I just think if you've maxed out everything else, I'm not saying people should just rush out and do this for their kids, but once you've maxed out everything else, I think it becomes an interesting option. I didn't buy it. I got the quotes and I've looked at it. I'm still not convinced, but it's interesting.
But so they have cash value in a policy. Like alternatively, you would have had more money, presumably. Say it's the same amount of money, but unless they need contractual help in the case of their death, right? Because it's a life insurance policy. Like if it's a $50,000 policy, you could just give them the $50,000 as a helpful parent later. Or if they needed to borrow against the policy, you would have had more money that you could help them with later.
Maybe.
Once they're an adult and there's maybe. If you're worried about your ability to give them the cash value of the permanent insurance policy in the future, I don't know, man. No. I just mean like there's a couple other things. Like in life insurance is far more creditor proof than other asset classes, even like RSPs and stuff. Yep. So if I get sued for something later on, that money is still theirs and still goes to them, and that would be protected. All right, I like that. And I think that, and you're gonna smack me for this, but I almost think of whole life as a separate asset class, because you're not, and this is partially your fault because of the permanent insurance paper you did. Because when I think of permanent insurance and like the dividends and the cash value are a function of not the performance of the underlying investments of the whole life policy, but a function of the performance of like the block of underlying insured versus their expectations. And I wonder if that's like a distinct and uncorrelated asset class to, say, markets, right? So it is, for me, I don't know, is it diversification? I'm kind of convincing myself of it here, but. It's going to be somewhat uncorrelated because it's going to depend on the insurer's claims experience versus their expected experience, partially, and also on the realized versus actual performance of the participating account, which will be affected by market outcomes. So it's not going to be totally uncorrelated, but the claims experience piece is going to be uncorrelated. But I don't know. I don't know if I'd call it an uncorrelated asset class. It's also smoothed, right? Like the insurance company smooths the policy dividends over time. Like if they have a really good year in the market, they're not going to distribute a much larger dividend. They're going to smooth it out over time.
But that's a feature, not a bug.
Yeah, I don't know. I think it's the same kind of smoothing you get in private asset classes. Private equity looks uncorrelated, but is it? I don't know. I think it's probably somewhat similar with insurance, except for the claims experience piece. Like so there are some sources of policy dividends that are not going to be correlated with financial markets for sure.
And I also think that
interesting. I don't know.
Is insurance also a tax diversification tool, right? Like we've been talking about capital gains taxes and the increase in capital gains taxes. Yes, there's a big threshold for that right now, but if capital gains taxes went up on every dollar to 75% in the future, the sort of marginal decision of whole life versus a non-registered account, I think becomes a lot more interesting, right? And so we talked about tax diversification on the webinar we did yesterday. And I just wonder if it's also, so I think when you look at like the creditor protection, the ability to transfer it to a child tax-free, the potential for diversification through the claims experience of the company, the insurability of the child being intact because at least they have some kind of policy. And again, after you've maxed out things like education funds, tax-free savings accounts, I think it does become an interesting tool to at least look at. I haven't bought it yet. So, right, like I've looked at it, looked at the quotes, and
you're paying a lot for, like, if you're doing a participating policy, which is what we're talking about with the policy dividends,
mm-hmm.
you're paying a lot more for that than you would. You could buy, unless you're going to keep the policy for a very long time and have very favorable assumptions about the future policy dividend rate, you could buy a guaranteed policy that has, like, I don't know, twice for the same amount of premium. You could buy a guaranteed policy that's, I don't want to say the number, I haven't run the numbers in a while, but a much larger guaranteed policy.
Like a non-participating whole life policy.
Correct.
Yeah.
Correct. You could buy a much larger policy for that, to the extent that, like, the participating policy, there's a decent chance that it will never reach the guaranteed cash values of a much larger policy.
Of course. Yeah. Well, and that depends on the dividend scale, I guess, right?
That's totally.
Yeah.
So when you see, like, an illustration of, look, you can buy this participating policy, but look at the future cash value. Look how high it's going to be. I always want to see the illustration at least current dividend scale minus 1%.
Yeah.
And I usually want to look at it at current dividend scale minus 2%.
Yeah.
And when you run those comparisons beside a guaranteed whole life policy, the cash values of the participating don't look so attractive. So you end up paying much higher premiums for the same amount of coverage,
mm-hmm.
with potentially more to show for it if policy dividends are great, but they're not by any means guaranteed. So you could end up being like, well, I should have just bought the guaranteed policy. Oh, well.
Yeah. But what if dividends go up, Ben?
Yeah.
What if it's plus 2? I mean, there's risk there, obviously.
You're taking risk there. And I would rather not take that risk.
Mm-hmm.
Like, if I wanted higher expected returns, I would buy the guaranteed whole life policy for the child if I wanted to do this,
mm-hmm.
and then invest the difference in stocks.
Interesting. I hadn't thought about the non-participating policy. I didn't get a quote for that, but
I like the arguments about there's a little bit of legal diversification in there,
mm-hmm.
creditor protection, whatever you want to call it, and the tax diversification is a real thing, because life insurance does get different tax treatment than other assets. So that's a legitimate argument.
I feel validated. Thank you. I am going to buy it now that you've rubber stamped it for me. Thanks, Ben. That was the entire purpose of this episode. I just wanted to get Ben's opinion live so that when I buy it, he can't make fun of me later. Like, remember episode 307, Ben? You told me to do it.
Topic number 2?
Yeah, are we done with insurance? Please? Okay.
Yeah.
Okay, so the principal residence exemption. So I bought 2 rentals. There was a point in my life where I thought I was going to be like a real estate, like, emperor of some kind, you know? Like, you read these books about the returns on real estate and all this kind of stuff. I was like, yeah, I'm going to build this real estate empire.
Because you can touch the walls and the bricks.
That's right. It's tangible. And I would go every week and I would just pet the walls of my rental and I would say, there you are. There you are.
Real asset.
Yeah. This is before the rational reminder, of course, and before I smartened up, but it was too late by then. I'd already bought 2. And they were pre-sale. One was a condo and one was a townhouse. One was a pre-sale condo in Vancouver and one was a townhouse here in Squamish. The condo I never lived in. It was purely a rental the whole time. Interestingly enough, that one just never really went up in value. We bought it in 2016. I sold it in 2023. So call it 7 years. And I made basically nothing on it. Like, yeah, we had rents, of course, but the value didn't really increase. No, in Vancouver.
Vancouver?
Yeah, 1-bedroom condo in Vancouver, East Vancouver.
How did you find the one condo in Vancouver that didn't go up in value?
I was going to say.
Well, it's funny because when you look at all like the private real estate funds, they seem to only find the ones that go up in value and not go down in value. And I seem to at least find the one that doesn't go up in value. So somebody's got to be buying the ones that I bought, I guess, right?
That's wild.
Yeah, it did go up a
Classic.
little bit, but it was basically a wash after the GST, because in BC you have to pay GST on new purchases. So I had to pay GST, and you factor in like realtor commissions and stuff, and it was basically a wash, right?
Wow.
It's kind of like the private credit funds. They also only find loans that increase in value over time. It's interesting how private
Fascinating.
funds tend to find those.
Those deals.
Yeah.
Yeah,
Very
so
impressive.
I'm the opposite. I can only find the ones that. Now, having said that, the one in Squamish did really, really well, and purely by dumb luck, right? Like COVID had a lot to do with that, I think, because here in Squamish, a lot of people left Vancouver during COVID to work from home, and I think a lot of people that wanted to live here who couldn't because of the commute or chose not to because of the commute, now that they were working from home, they came to Squamish, and so we saw a really, really big increase in real estate prices. So given that the condo in Vancouver was a wash, we'll just talk about the townhouse. So we bought the pre-sale in 2016, late 2016, and it completed in early 2019. And technically, when you buy a pre-sale, you don't actually own the property until it's completed, right? It's kind of like a call option. Like there's features of a call option in there, I would say. Like you have the right to buy it when it's complete. It's a little bit harder to sell than a call option would be, but you basically are buying the right to move into it when it's done,
It's
right?
not yours until closing.
Basically. So for the purpose of calculating the principal residence exemption and ownership, you don't really own it until 2019, even though you've technically kind of bought it in 2016 in my case. So it was complete in 2019, and when it completed, we moved into it. So February 2019, we moved into the townhouse, and we did this just to kind of test if we liked Squamish, because we were moving from Vancouver, and we decided we wanted to stay. So in April of 2020, about 14 months later, we bought a home here for ourselves in Squamish, but we kept the townhouse as a rental. So April 2020, we turned it into a rental until we sold it in the summer of last year, 2023.
I've got a quick question. Did
yeah, of
you
course.
did you do an appraisal when you turned it into a rental?
No. And so this was a really interesting topic that came out of some of the discussions when I wrote this on Twitter. And in hindsight, I think I kind of lucked out, because what you can do is you can appraise it and then you can submit it like a change of use. And you can kind of basically tell CRA, I'm turning this into a rental now, right? So then you lose the ability to claim the principal residence exemption the same way. And I can only claim it for those 2 calendar years that I lived in it, 2019 and 2020. It's only those 2 years that I can kind of eliminate in terms of the growth of the property. But a lot of the growth of the property happened after I turned it into a rental, like from 2020 to 2023 is where a lot of the growth was. And so thankfully I didn't submit a change of use for that property. And as a result, it worked out in my favor even better. But to your point, you can do that. You can get an appraisal. So let's say I bought it for, I'm just going to make up numbers here, but let's say I bought it for $600,000 in 2019 and it went up to $700,000 in 2020. That $100,000, you can submit a change of use. That $100,000 is exempt from tax because it's your principal residence for those 2 calendar years. And then from 2021 onwards, it would all be taxable. When you do that, you're not able to kind of average out the total growth of the property over the years you owned it, because you're basically saying it's these 2 years of gains that I'm claiming as the principal residence exemption. The way we did it was a little bit different, because I didn't do that, and I'll get into the details, but because I didn't do that, when we sold it in 2023, we owned it for 5 calendar years, 2019, 2020, 2021, 2022, and 2023.
Yep.
We lived in them for 2 calendar years, 2019 and 2022. But the way the principal residence exemption is calculated is they give you what I call the +1. So if you actually look at the formula, there's a +1 in the formula. So the actual formula is the number of years it was your principal residence +1 divided by the number of years you owned the home times the capital gain. That's how much you are exempt for for the capital gains. So in my case, I lived in it for 2 calendar years out of 5 that I owned it, but I get to add +1 to those 2 calendar years. So I owned it I lived in it rather for 2 calendar years. I get to add +1. So 3 calendar years divided by the 5 years that I owned it is 60%. That's how much of the capital gains exempt. And the reason for the +1 is to account for the fact that people own 2 principal residences in a single year when they move, right? Like in my case, we owned that home in 2020 plus the home we live in now in 2020. So they give you the +1 as a way to account for those calendar years where you own 2 homes as a principal residence. But it's just fascinating the way it worked out, where it exempted 60% of the capital gain.
Mm-hmm.
What's even better though is I didn't lose any of the capital gains or the principal residence exemption on my current house. Because even though I've already claimed 2020 I've already claimed that townhouse as my principal residence for 2020, when I go to sell this place, 2020 is off the docket. I can't use 2020 against this house. I can only use 2021 and onward. But because of the +1, I can basically recapture the calendar year of 2020. And so if I sell it, say 10 years from now, let me just find the formula here again. But if I sell it after owning it for 10 years, I get 9 years where I can claim it as my principal residence. I can't use 2020 anymore. But because of the +1, I get to
get it back.
10 years divided by the number of years I owned it, which is 10. So it'll be 100% exempt from tax.
That's cool.
Yeah, it was just a really interesting outcome, I guess. And then we used RSPs, and both my spouse and I owned that property. And because she has no income, half the capital gain was hers. And so the way it all worked out is net as a family, we ended up with about a $3,000 tax refund last year, even though that property went up by quite a bit.
Super interesting.
So the key is the change of use notification. That would have locked in the gains at that point in time.
Yes, exactly. So had I submitted a change in use instead, 2019 and 2020 would have been exempt from tax.
Yeah.
2021 to 2023 would not have. But because most of the growth happened in 2021 to 2023, I would have got pinched for the big growth years. Yeah. And I think there's a really interesting 4-year look back rule, which always confuses me. I don't know if you guys have heard of this, but if you move out of your home and turn it into a rental and you later sell it, you can actually go back 4 years and claim it as your principal residence, even though it wasn't your principal residence and you turned it into a rental. Now you would lose the principal residence exemption on the current home you live in. And so for me, I didn't want to do that. That didn't make sense. But even if you turn it into a rental, you get like this 4-year window where you can still claim it as a principal residence. I might have that wrong, so somebody will probably correct me on the forums, which they like to do lately, apparently. Hey, Ben?
Just a little bit. People, you ruffled feathers with some of your physician-related content.
Yeah, the headline specifically, but
yeah.
Oh, good.
So do we want to take a stab at this next question?
Yeah, I mean, my answer to this question is super simple, but let's do it.
I think all of ours will be pretty simple and nobody will be surprised. So Ben, how would you invest $1 billion today?
I would put all of it in DFA 607, which is Dimensional's Canadian global equity portfolio. Basically, global market cap weights with a Canadian home bias with a small cap and value tilt across all stocks in the world. That's how I invest my money now, and I would do the exact same thing.
Lump sum,
Yeah.
no dollar cost average. Check comes in
sum.
today, order goes in tomorrow for the full $1 billion.
See you later. Place
I
the
mean,
trade.
$1 billion's so much, right, that you could live with volatility, like especially the spending habits that the three of us have. I thought I'd do 70-30, but the number's so big, like I'd do something either 607 or whatever the 70-30 code is, something like that, and be done with it. I have no interest in doing private equity or finding other fancy investments or real estate. Like simple, man, it's just a thing of beauty to me. And markets work. I remember your tweet, Mark, where you said something like, if I had $1,000, how would I invest? If I had 10,000, and you scaled it up, and it was the same answer all the way along, globally diversified index type portfolio. And I completely agree with that. Especially this philosophy is all about the fact that markets work.
Yeah.
And the markets are so much bigger than if any one of us had $1 billion.
Yeah.
So
Well, that's
why
the
not?
question, right? Like, is $1 billion enough to move prices? But if you're handing it over to an institutional manager, I guess they've got a lot, easier ways to enter. But if you were buying a single stock with $1 billion, that could move the price. But
So
The
what
stock,
would you
how
do?
much is
The whole
Okay.
life, the whole thing, whole life policies for my kids. Obviously, I thought that was obviously. No, I would be half whole life and half Bitcoin actually. But no, I don't know. I don't think it's interesting, Cameron. What you just said is that you can just accept the volatility when you have that much money, right? Like depending on how you spend. But I think there's also the question of do you need to take that kind of risk as well? And if you define risk as volatility, which I know most of us don't, but I think like could you look at your statement and see negative 200 million on the statement over a few month period? Yeah, fair enough.
Don't look at it now. I would.
Yeah.
I've looked at my accounts and I don't know when the last time I looked was.
Yeah.
I don't even know how much is in there. I know how
Same.
much I put in there every year. I don't know how much is in there though.
Yeah.
Honestly couldn't tell you. Probably couldn't tell you within tens of thousands of dollars at least.
So you're doing your own homemade volatility laundering, basically.
Yeah.
Exactly.
Basically.
That's it. The only reason I have an idea is because I had to take money out for this landscape project, and it was the first time I checked in a long time, and it was much higher than I thought it would be because I hadn't checked in a long time. The markets have been pretty good. I was like, oh. But the problem with that is when the landscaper started going like, oh, do you want this? Do you want this? Do you want this? And the bill started going up. I was like, yeah, I can afford that because I saw my portfolio and things are going well, right? So it kind of reframed my decision to spend more on this project. But I think it's interesting for very wealthy people, somebody who's just landed with $1 billion in their lap, their capacity to take risk goes up exponentially, but their need to take risk goes down exponentially. And so I wonder if that decision comes down to tolerance for risk more than anything else.
Yeah, willingness to take it on, as Larry Swedrow would say.
Yeah,
How willing are
exactly.
you?
But my answer is the same as you guys, and I don't want listeners to actually think I would buy whole life in Bitcoin. It would be DFA 607 as well. Just globally diversified index fund portfolio of some kind with dimensional funds. Obviously, we have the factor tilts.
Okay, Ben, why don't you queue up the next question?
The would you rather game.
Yeah.
Okay. So the first one is the question that I thought of when I thought of this segment for the podcast. I sent it to Mark in a message that, what do you think of this would you rather game for the podcast? And then I suggested a couple questions. So this was one of them. Mark thought it was pretty good. So I'm going to ask the question, and you guys have to answer. Would you rather? Would you rather have only life insurance or only disability insurance?
All day long, disability insurance.
That's such a good
Just
question.
based on stats. I mean, I couldn't find the stats for the chance of a 58-year-old becoming disabled, but 1/3 of people will have a disability lasting greater than 90 days before they reach age 65. Right? Whereas I have just over 1% chance of dying this year. So disability, especially the younger you are, disability all day long. Mark?
Yeah, and that's the younger you are, I think is the key here, right? Because it's so situational. Like the probability of getting disabled is obviously much higher, but the financial impact is going to be dependent on your age and your current financial situation and everything else, right? I think disability insurance, but I wouldn't say that answer applies to everybody, but I will say it applies to me.
I don't know. I would need, and I thought of the question, I should have looked at the statistics, but I would need the statistics not just on disability, but on like a disability lasting more than 90 days could mean a lot of different things.
Mm-hmm.
And we all work professional services jobs where, and I know, Cameron, you gave this example earlier that I could always go to my computer, whatever. But I would want to see statistics on the proportion of people that are disabled to the extent that they can no longer work like a desk job. Probably I would rather have disability, but I would want to dig into the statistics on that.
Well, and the duration of the disability is important too, right? Like I think a disability can be long but temporary. It could be 2 or 3 years. So there's a lot, like to bend this out. I think you'd have to look at a lot of stuff, but like off the
cost of disability could be a lot higher too, right? If you're unable to work, or the cost of care might even be higher, where the need for total capital could be a lot larger than what it would be for life insurance.
Yeah,
possibly seen those situations before.
Yeah, disability insurance is expensive, and it's also much harder to get these days too. Like if you have, I don't know you guys don't do insurance, and I don't do it anymore either. But even last year, I was finding a lot of difficulty getting disability insurance approved for clients. And when it was approved, it was really expensive, which makes sense from the insurance company standpoint. But as the end user of the product, it's tough.
Yep. It is expensive. My disability policy, which is a very, very good policy, but it costs almost the same as all of my life insurance.
Mm-hmm.
Yeah. Okay, you guys good to go to the after show?
Let's do it.
Are we just doing one would you rather question? Yeah.
I think one per episode is good. We don't want to burn them all out in the first 4 episodes and then have no inspiration or ideas for other ones.
Okay, I got a topic for the after show. I want you and I talked about this this week or last week, Ben, but just the learning and the improved help in making financial decisions that happen by you going through this capital gains thinking with software, working with Braden. I thought that was so interesting.
I mean, it's still ongoing. That's why I didn't prepare for this episode, because that's all I've been thinking about. Yeah, Mark Soth too, the Money Scope co-host. That's all he's been thinking about too. And we've been exchanging notes and experiences as we go through the analysis, and it's complicated, man. It's really complicated, and it's a lot to try and model. I think we're at right now, we do have a functioning web application internally. I don't know if we're going to release this one to the public, honestly, because it's so complex. I'm a little bit worried about model risk. Like if someone puts a set of inputs in that don't agree with how the model was set up or something, and they get a weird output, I don't want people to make decisions, bad decisions based on that. So whereas an advisor would be more likely to be able to spot that doesn't seem right. So I don't know if we will. Well, we still have to make that decision. We have not even released it internally yet. We've shown it to the advisors. We've gotten feedback and stuff like that. But it's it's been an interesting process to think through it for sure. We will do a money scope on this. Mark and I are recording on Monday.
So does it boil down to any rules of thumb might be too light a term, but any sort of general guidance? And I'm not asking for the guidance, but just having ground through these details for a few weeks now, does it kind of come down to a few key points, or is it just so complicated you need some sort of model to operate?
I mean, there's some stuff you can kind of start to build intuition around. So just to be clear for listeners, we're talking about realizing capital gains in a corporation. The individual one for just your individual personal assets, we built that calculator within, I don't know, a week of the budget coming out. And that's
4 days, yeah.
Yeah, that's been available to the public for a while. The one for corporations is a lot more complicated because it interacts with spending and income. Like if you have a corporation that you're running a business through, you have revenue coming in, you're paying yourself through salary and dividends, and that makes the decision of whether or not to realize a capital gain in the corporation a lot more complicated to think through. And there are a whole bunch of different trade-offs. I don't want to turn this into a money scope episode, but basically if you realize a capital gain in a corporation, it creates capital dividend account, which can come out tax-free to a shareholder. And so you can end up deferring a bunch of personal tax by paying yourself with capital dividends for a period of time, depending on how large the capital gain was. That's good because it defers personal tax. But there's also a trade-off there where if you're deferring personal tax by living off capital dividends, it means you're not paying yourself salary, which ends up reducing your lifetime RRSP room. And so one of the things that both Mark and I are finding is that actually is detrimental.
And CPP as well.
Yeah, you're missing out on CPP. I don't have CPP in my model. Mark does, but he treats it as an asset with a 2% expected real return. So it's not perfect. My model excludes it, which basically just assumes it's a wash. I'd like to build it in eventually, but just haven't had time to do that. But yes, so if CPP is not a wash, which is kind of what my model assumes, then yes, you're missing out on that too. And I don't think it is a wash. Like it is a positive expected return asset, especially if you live to age 95 or whatever. So you miss out on RSP room, potential IPP room as well. You miss out on CPP contributions. You defer personal tax, which is cool. The other thing that happens is that, and again, I don't want to turn this into a money scope episode, but when you realize a large capital gain in your corporation, it adds to your adjusted aggregate investment income, and adjusted aggregate investment income reduces your small business deduction. And basically, for people who aren't familiar with Canadian corporate taxation, which is probably most people, it basically means that you can end up paying more corporate taxes. So if you have a lot of aggregate investment income, adjusted aggregate investment income in a previous year, that reduces your the limit that you have to pay tax at a low rate in your corporation the following year. So you can pay a bunch more personal tax. The knock-on effect of that is that it actually lets you pay dividends to yourself more tax efficiently. It lets you pay eligible dividends to yourself, which you pay less personal tax on. In Ontario specifically, there's a funny anomaly where the province of Ontario does not recognize the reduction in the small business deduction due to adjusted aggregate investment income. And so you can actually end up in a situation where that's advantageous. So that's one of the things. New Brunswick is the same. So one of the things we have noticed is that in Ontario and New Brunswick, realizing a capital gain in the corporation is more advantageous, all else equal, compared to, say, BC or Alberta. Yeah.
So you see why I asked the question?
It's a big question, eh?
There's a lot in there. I don't know. It's a complex decision. And we're getting a lot of questions from clients about this. I think there are some cases where it's much more obvious. Like if someone has a large known expense in the next couple of years, then realizing a gain to pull out the capital dividend account is much more likely to make sense. The other thing the other big thing that I've noticed is that all of this is super sensitive to optimal compensation. So we did a couple Money Scope episodes on how to pay yourself from a corporation.
Yep.
And this decision of whether to realize a capital gain or not is largely dependent on your ability to implement the right sequence of future compensation after realizing the capital gain. So if you realize a capital gain in your corporation, then continue paying yourself salary, and you realize the gain for no reason other than to realize the gain before June 25th, that's likely going to make you worse off, almost certainly going to make you worse off. Whereas if you do the right sequence of eligible dividends, non-eligible dividends, capital dividends over the few years after realizing the gain, then it can make things look a lot better. Because there's a whole bunch of, like, a big portion of the tax when you realize the gain is refundable. But to get that tax refund in the corporation, you have to pay yourself a non-eligible dividend. So, yeah, if you just keep paying yourself a salary, it's no good. But if you get the sequence of future dividend stream right, then it can start to look more advantageous. But again, it's super situation dependent. The other big thing is the size of the gain relative to your personal spending needs. If it's a huge gain and you have low personal spending needs, realizing the whole gain is probably not going to make sense. If you have a huge gain and really, really high spending, it can start to look more attractive. I don't know. Maybe there is no intuition. Maybe it's just really complicated.
So do you think in general the awareness around all these notional accounts and kind of the intricacies of tax planning and corporations has increased due to this? Like, do you have any general observations? Or
I don't know if it's increased due to this, but I think when Mark and I did those 2 episodes on optimal compensation from a corporation, I think that was a big light bulb moment for a lot of people. I've heard from a ton of people who were just like, wow, I had no idea about any of this. So I think at least people who are listening to Money Scope are becoming aware of this. And I think it is really important. It makes a big difference in the long run.
So the proposed tax changes may have been an accelerator.
To make people think about it? Yeah. I mean, I don't know. People who haven't been listening to Money Scope probably still wouldn't be thinking about this.
Right.
I had advisors reaching out to see if they were allowed to attend the webinar that we put on yesterday on optimal compensation, right? So I think this is totally anecdotal, but there's obviously interest in this concept amongst at least some advisors, right? And it's like, to your point, it's so complex, and like there's probably very few people in the country besides you and Dr. South that understand it to that degree, right? So and giving all this research to the public for free, I think there's for a lot of advisors, they're like, oh, there's this whole thing I hadn't really considered, and I just thought was the domain of accountants, which, obviously we need the accountants to help us with this, but you're projecting 30, 40, 50 years of optimal compensation versus non-optimal compensation, the difference in outcomes is just huge, right? So it's encouraging to see at least that other people are interested.
Yeah, and the webinar was a great success. You had almost 300 people, which is amazing.
That was crazy. So I basically just did the opening remarks and the end. So Brady Plunkett, our colleague, is a portfolio manager and financial planner, and Spencer Brooks, who's a tax partner at Hendry Warren, who's an accounting firm out of Ontario that we work very, very closely with. They did, most of the heavy lifting for the content of the webinar, and they just crushed it. It was really, really good. I was trying to monitor the chat and answer as many questions as I could, and I couldn't even keep up. There were so many people asking great questions in the chat, and I was trying to get as many answers in there as I could. But I think we peaked at 270 attendees, and again, lots of great questions, lots of great engagement. Should be available on YouTube, I guess, once it's kind of uploaded, and I don't know when that's going to be.
I know you talked about IPP, so I know Brady's had a few people reach out to talk about that.
Oh, interesting.
Since the webinar, so.
Yep. It was great. They did a really, really good job. I told Brady I nominate him for the position of chief webinar architect going forward. He just crushed it.
He brings the energy, that's for sure.
Sure does.
We do want to build, once we're done with this corporation realizing the gain or not modeling, I think we're going to be able to use the model that we build for that to build an optimal compensation calculator application, whatever you want to call it. So people will be able to put in their notional accounts, their portfolio balance, and all that kind of stuff. And it would spit out Mark South already has this on his website, to be clear, so we're not reinventing the wheel here. He's got something very similar. But the idea is that you put in all of your information, and then it spits out how you should pay yourself in this year.
Very cool.
And that's a request we've had from advisors internally to help them give advice to clients.
The capital gains calculator for non-corporations is available on our website.
Yep.
Cool.
Yeah, it includes AMT, which we talked about in a past episode, I think.
Mm-hmm. Yeah. Alternative minimum tax, yeah.
Mark, do you want to read out the first review we got?
Sure. Yeah, so this is from DH at Winnipeg. Great for self-directed investors. Always interesting content. I've been fascinated by the parallels between medicine and finance. Some professionals in each sphere trying to make the optimal decisions for clients using a body of evidence that has limitations and caveats. Others making unsubstantiated claims of getting better than average results with more expensive products. What was that?
Such a good analogy.
That's great.
Yeah. Ben,
I had someone tell me actually, I'll do the next one. I had someone tell me a while ago that the episode we did, they're a physician, the episode that we did with Dr. Wendell Mascarenhas, where he talked about the evidence pyramid and talked about the analogies between medicine and investing. Someone told me that was a huge light bulb moment for them. We just really hammered home the idea that there are for sure limitations with what we can do with evidence and how certain we can be about anything in financial economics and portfolio management. But there are at least parallels. I think that comment kind of touched on that, where in both cases there's uncertainty, and in both cases there's competing evidence, but people are like, all you can do is use the evidence to try and make the best decisions possible. I think probably the big difference still between financial services and even just bigger than I guess it's all financial services, asset management, all that kind of stuff. The big difference between that and medicine is that in the case of financial services, a lot of people just aren't using the evidence at all.
Yeah. It's funny. I had a client of mine. I called her a scientist, basically. She's a physician, right? And so I was talking about the science of investing, and I thought she'd appreciate that. And she told me, she's like, "Oh, you'd be surprised how little science there is in medicine." And she didn't elaborate, but this was years and years ago, and I still remember that comment. It's really, really fascinating. But to your point, I think there's other parallels too. Like I made a diagram once on the parallels between the diagnostic process that physicians use and the financial planning process, even down to referring out to specialists and monitoring the health outcomes of patients. And there's a lot of analogs, I think, between the two practices.
Yeah, really interesting. All right, next comment from Randall in the United States. Exceptional evidence-based show. The rational reminder is an exception. I think they mean exceptional. An exceptional evidence-based show in a field filled with self-interest and strong opinions that lack the necessary. That's what we were just talking about. that lack the necessary depth of understanding. I am American, so not sure everything directly applies to my situation. But this might be the comment that I was thinking about when I said the thing earlier.
Mm-hmm.
Yeah.
I'm American, so not sure everything directly applies to my situation, but the logic and reasoning behind the decision making is often useful regardless. For example, tax diversification is a concept that absolutely applies with 401k and Social Security, or TFSA and Canada Pension Plan.
Very nice. And then a common friend of all of ours with a great first name, Cameron, reached out to me. I think it's a bit of a sympathy note that sent to me on LinkedIn, but it was very kind to hear from him. Great guy, great advisor. Since you didn't get any LinkedIn reach outs on the last episode, private credit, I thought I'd send you one for the next. Lots of chatter around the show being mandatory listening for new advisors, but I would argue it's even more important for existing ones. Timeless advice, and both you and Ben's ability to distill seemingly complex topics down into easy to understand language can't be celebrated enough. Thank you for all that you guys do for our industry. Mark has been a great addition, and I look forward to the show every week. So, Cameron, thank you very much. Very kind of you.
That reminded me that I did get a comment on LinkedIn on the private credit episode. I want to find it because it was really good, and I asked for permission to share it. So this is from someone who they're currently an advisor, but they've worked in finance, but not as an advisor previously. So they said that they used to structure private credit investments on behalf of life insurance clients, so like institutional clients, at a previous firm. So they said that the private credit episode hit close to home, and then they gave me some anecdotal observations based on their experience creating private credit investments for institutional investors. So they said that oftentimes the financial covenants negotiated in private credit transactions are weaker than they would be in a public bond deal. And that's to give the borrower financial flexibility in order to make payments. There's also a huge amount of concentration risk, since the firm that's underwriting the private credit transaction usually wants to take a big chunk of the deal for themselves because they're doing most of the heavy lifting on the analysis. And so that means that if a deal does go south, they will have a bad time. They might not be able to unload it to someone else, and they're obviously concentrated in the investment. And so the funds may have multiple transactions in each fund that gives the illusion of diversification. But his suggestion is that in a lot of cases, they probably own a big chunk of each transaction, which makes them pretty illiquid and risky. And then he said that life insurance companies and others, like we talked about this briefly in the private credit episode about internal valuations as well. They're allowed or internal valuations from the fund itself. So they're allowed to provide internal ratings and internal prices on most of the transactions, and so that lets them give a credit rating of kind of whatever they want and a valuation of kind of whatever they want. That may be misleading, smoothing to a point where it's misleading. We talked about that in the private credit episode too. Anyway, so really interesting. And I asked him, he told me all that, and I just said, what did you think in general about the accuracy of the episode based on your experience? And he said that it was great and kind of hit the nail on the head in terms of what's really going on under the hood in that asset class.
That's awesome.
That was good to hear. Not every day you get to hear from someone who's like been in the trenches doing something like that, give their thoughts on it.
That's great.
I have a story for you guys. My daughter and her boyfriend leased a new car this week. So I went for the quote meeting. Incredible how it's still you can have such a shady experience in such a big brand name, incredible industry. And I'm not that demanding, but I like to know some details. All she got until I pushed for it was written down what the monthly payment would be. I'm like, well, it's based on how much down, what's the residual, what's the interest rate, what's the, I get it's kind of mathy and we might be skewed that way, but you can't just my daughter's not a math person. That's not her gift to the world, right? So she gets this number, so that's affordable. And so we have no idea what's in there, including a trade-in. She was trading in her old car, which is paid for, right? So that payment plus your car is what you're paying for this. Like, oh, okay, so should have started thinking about what the total cost of ownership is for the time of the lease. But to throw a chicken scratch number that your monthly payment is across the table. And I said, well, I want the details. Well, I'll have to do up a bill of sale. I'm like, well, we don't want to buy. We just show me the numbers.
Mm-hmm.
So you have to wait 20 minutes. They go back to some manager's office to come back with this bill of sale that they forced me to take a picture with on my phone because they wouldn't give me the piece of paper because it's a contract.
That's wild.
I couldn't believe it.
Wow. But yeah.
I just did that too, actually. I also forgot I wanted to talk about this in an episode. Maybe I can mention it now. So I also leased a vehicle recently. My experience was not like that at all. I got a extremely clear sheet that showed the sale value of the vehicle, the residual value, the interest rate of the financing on a lease. I lease my vehicles. I'll talk about that. I know people are always interested to hear this. Anyway, that experience was fine. But I was just thinking about leasing versus buying a vehicle when I went to do this. What was I thinking about? You when you lease a new vehicle or buy a new vehicle, the biggest cost is depreciation. You're eating a whole bunch of depreciation early on, and that's never fun. You can reduce the depreciation cost of vehicle ownership by buying used vehicles because a lot of that depreciation has already been paid for by somebody else.
Depending on the brand.
Like in general, any vehicle after the first 2 years is going to have a lot of its depreciation already gone down. But for sure, you can look for vehicles that hold their value better. And then the other ones are financing costs, and you pay a financing cost no matter what. Whether you lease, finance, like borrow, or pay cash, you're paying a financing rate. If you pay cash, it's the opportunity cost of what you would have otherwise done with the cash. If you borrow, it's the borrowing rate, and if you lease, it's also the borrowing rate. So the big difference is really depreciation, the depreciation cost.
So why'd you lease instead of buy?
I don't like owning vehicles. I don't like at the end of when I'm done with it. I don't like to have to deal with negotiating a sale price and all that stuff. And you're taking some price risk too. I mean, during COVID, I think used vehicle prices were super strong.
So you're looking for that sweet spot of interest rates and higher residuals in your world, right? So after having talked to a number of dealerships, they kind of look at me like I've got three heads. I'm like, don't you get what I'm talking about? Like, where's that sweet spot? Because you get a newer car, it's got a higher residual, which might lower your payment depending on the interest rate or other incentives. It's like, am I weird for like thinking this way? Like, this seems so logical once you understand how a lease actually works.
Yep. The other thing, that the reason that we did this, so this is before our lease term was supposed to end. But what happened was we moved out to the country early on in this lease and ended up, we are on pace to quite meaningfully go over our allotted kilometers. And so the penalty would have been, if we kept up the same pace of driving, the penalty would have been about $5,000 when we returned the lease, which is obviously no joke.
Wow.
So we negotiated that down to $2,500, and we were able to roll that into the lease. And the lease rate's 3.99%. So as a cost of capital, I thought that was pretty reasonable, instead of giving them cash to cover that penalty cost.
Yeah, buying a car is just not an experience I want to go through again anytime soon.
Do you buy or lease?
I used to buy used vehicles, which is also just a different. And I know less about cars than probably anybody you know. Like, cars have just never been my thing. I don't understand them, and so I'm obviously ripe for being taken advantage of when it comes to these transactions, which is also why I try to avoid them as much as possible. I just don't like cars all that much, and so I used to buy used cars. And then when I finally got like my first kind of big boy job a while back, I think it was when my wife got a significant promotion, or there was some sort of financial event in our life. Like, oh, we should buy our first new car. So we bought, I think it was a 2018 Mazda, and it was just no no upgrades, nothing, like the absolute base model. And they tried to upsell us on every single thing, and like maintenance packages and everything else. And like what I thought was going to be a relatively painless, because we knew exactly what we wanted, the color and everything. And it took hours and hours and hours to just get out of there with the car that we wanted. And I just felt really like I needed to take a shower after. And I kind of decided like I'm never going to go into a dealership and buy a new car again. Even if I now know what to expect from like the sales pressure, I just don't want to experience it again. And so even though I kind of want a new car at some point in the next couple of years, we don't need one. We don't drive very much. We just have the one car between us. That experience alone is like sticking in the back of my throat, and I just don't want to deal with it.
Yep. I agree with all of that. I think that's one of the reasons I like leasing, is that the information asymmetry, like you can't get taken advantage of beyond the potential that the residual value is taking advantage of you in some way. Like if but you know exactly what the car is going to be worth when you return it. Like you're pre-agreeing on the depreciation. And
depending on your usage, right? Like my last lease, I was way under mileage. So how much equity do you get? So I ended up buying out my car because I was 40,000 kilometers under the usage. Well, if I rolled into another lease, that equity would have been largely vaporized.
Is that negotiable?
Yeah. You can try.
At the time?
They told me that I might have a few $1,000s of equity in there. I'm like, it's a little.
But I mean, is like the number of kilometers that are like that limit in your driving, is that negotiable?
It's not negotiable, but you can pay for a higher limit. It's negotiable to an extent. I mean, everything's negotiable. The interest rate's negotiable. The price is negotiable. Every single piece of the transaction is negotiable, which is like the worst part about buying a vehicle. I actually had so when you buy a vehicle, you have like the salesperson, the business manager who like limits what the salesperson can negotiate, and then you have the finance manager that you have to talk to about if you're going to lease or finance the vehicle. And so the salesperson was talking to the business manager, and he goes back and I'm going to go and try and get you the best price. Whereas he comes back and shows me the quote or whatever, which was super detailed and clear and made sense. So I called my wife and explained to her what was going on. And she was like that, it seems like they can do better than that. Like, I don't know. And I was like, man, I don't know. Like, I asked the guy to give me the best deal. That I don't know what you want to do. And so I walked over to the business manager, who's like in a separate area. I don't think he was expecting me to come talk to him because he's supposed to talk to the sales guys. And I was like, excuse me, would you talk to my wife? And he was like, he said no. He's like, no. And I was like, please, can you just talk to her? And he's like, okay. Super awkward. And I gave him the phone. I don't know what they talked about. They were on the phone for like 15 minutes and came away from that conversation with another, I think, $1,500 knocked off between the price and the, a couple other things. But yeah, that was also interesting. Also drives me nuts though, that it's such a negotiation.
Oh, I know. Just give me the bottom price and like just be done with it. Like I don't want to deal with the back and forth. Like let's just settle on the price. But you have to negotiate because you know to your point, or at least to your wife's point, that there's usually room to go lower, right? That's $6,000 an hour. She just saved you. Not bad.
Yeah.
Just send her in. That's the thing though. She's now accepted the position of leasing the next car for your family.
That's what the sales guy said. He was like, "Wow, does your wife want a job?"
Nice.
She's something. All right. Good to bring this in for a landing.
Yeah.
Think so.
All right. Everybody, thanks for listening.
Thanks.